Hello. Yeah, thank you. So please record if you can. In the meantime, allow me to share my screen. And today we are going to do something good. So we are going to dive into automated market makers. I know we have a lot of work to do with smart contracts, but we shall be, tackling it like slowly by slowly. Maybe some sessions. I felt like maybe today we could have some smart contract sessions, but why not begin a week on a strong note? And yes, we can get away of covering more solidity within the sessions. So I think this is called whiteboard. Is it whiteboard? Micro.com. So let me try to have my whiteboard on. Meanwhile, I can share the screen. Thank you for the reminder. I'm getting more used to these whiteboards, which is cool. So we want to make automated market makers. The three topics that we have is one, then I think the second one could be Node, JS Express. I think I can add on a database. i.e. MongoDB. Depending on the time, I think, depending on how automated market makers will go. And then on this we can see if we shall have time to look at using front end invite to send backend data and retrieve it. So the last two are sort of optional. It will depend on the mode or the consumption or the time that we have. So we are starting with AMMs. And I think So what are automated market makers? So as always, most of us are used to buying crypto, for example, through centralized exchanges, for example, Binance, Coinbase, etc. Oftentimes. But we resolve to the same platforms when trading between different cryptocurrencies. However, centralized exchanges are rife with problems. They can get hacked and lose all their users' money. Or worse yet, the company behind the exchange can close up shop and run away with all the money. This may seem extreme, but I think it is something. And of recent, we've been experiencing, unprecedented hack on Bybit, and there is a bounty. I think it is called LazarusBounty.com. So if you're one of those people who can track monies, there is a 10% white hat hack bounty, which is $1.4 million. So the amount that was stolen was $1.5 billion worth of ETH. It was 400,000 ETH. Yeah, so these guys have really put up something, and they are tracking the wallets that this money is being split to or sent to. Yeah, and if you really alert them or have the capacity to freeze the money, then you have a chance to win. For example, here we have the alert actors. So these are the actors that refuse to cooperate. And so the good actors who cooperated. I don't know, this is incredible, like looking at but these guys have demonstrated good power of hunting down. I don't know if I can, let me see if okay. Yeah, so builders, you can look at really the way they are aggregating, the way funds are moving. It's really submit a lead. All right, so away from that, I think there have been many issues. So examples of the early success that faced closure, we have mt.gox. So you can search on what happened to it, but on a brief show, it was a Bitcoin exchange based in Shibuya, Tokyo, Japan, launched in 2010. It was handling over 70% of all Bitcoin transactions worldwide. In early 2014, they reported the way so yeah, I think the company got, I don't know what happened, or robbed. But in early 2014, the company reported they were missing hundreds of thousands of Bitcoin and declared bankruptcy. Today, those lost Bitcoins are worth billions. Of course, we know that. So in the following year, MTGX faced several lawsuits, some of which are still going on 8 years later. So you can read more about what happened. I think I can share probably. I was reading it from here. Yeah, this is their case. So I can share it probably after the session. You can read more about it as we are. We are really establishing why we need things like AMMs, automated market making, and what they are. So all the way from the days of Bitcoin, then from mt.gix we had Quadriga CX. These were Bitcoin centralized exchanges, and some lawsuits are still ongoing. Others, downfall of crypto asset trading platform resulted from a fraud committed by Quadriga's co-founder and CEO. Yeah, so reading about this is really an amazing thing. So it went down in 2018, and the founder mysteriously died, and all the crypto on the platform disappeared with him. Someone put up their hand. Okay, I think I can go on.
Just wanted to add something little about Quadriga CX. There's a whole documentary about it. It's called, I think it's Chasing the Crypto King, something of that sort. But it really brings out the whole story of how the scam came to existence, and it explains centralized exchanges in a way that I think is helpful. So maybe I'll share the link so whoever can watch it later will be able to get the information.
That's awesome. Yeah, so maybe you could share, that documentary and we go through it, because it is very easy for us to, due to the convenience, how convenient our centralized exchanges are, we quickly forget about maybe the laws of your keys, your crypto, or yeah, the power of just having your tokens um, on your own wallet, on your decentralized wallet. Yeah, so we often forget them because there is a lot of convenience. You can quickly exchange things, but literally, if the exchange decides to close up, they will not contact anyone, and people will really end up losing a lot of money. And right now, we have now the issue of Bybit, but good enough, Bybit could handle it internally. They had that money to replace the stolen amounts, and yeah, even if it was because the Bybit saga wasn't due to the inflows in the Bybit ecosystem, but due to transactions they signed. But you see how fragile this can be. Like your money, your crypto, your keys, your crypto. So therefore, what is the problem? Excuse me. Of course, there are very many others I've left on the list. I think FTX, we know about it, but we can continue and see. So the birth of, I can say, decentralized exchange. So because of these really the downsides of centralized exchanges, so we ended up having a new concept which was born in the Web3 ecosystem. So the idea of a decentralized exchange is simple. Allow users to trade their crypto directly on chain through smart contracts without giving up control of their private keys. That is it. So with your non-custodial wallet, is it non-custodial or custodial? With the wallet that you own, probably MetaMask or any other wallet where you have full sovereignty over your keys. Yeah, you can be able to trade or exchange tokens on decentralized exchanges, maybe probably from one chain to another, or tokens on the same chain but different tokens. So while it sounds simple, the realities are much more complicated. In short, decentralized exchanges are a beautiful piece of mathematics and software combined together. Yeah, so let's hope by the end we shall really have broken it down, and then everyone can get to know it. So one of the prominent decentralized exchanges is Uniswap. And how was Uniswap birthed? So you can come here, connect your MetaMask wallet, and do exchanges on chain. Yeah. So the birth of modern decentralized exchange was primarily led by Uniswap. Not only is Uniswap the leading decentralized exchange on Ethereum, it is the leading DApp on Ethereum in general. So since the power of Web3 or decentralization or blockchain is that sovereignty, you can own your thing. No one stops anyone from spinning up their own versions of such protocols in their own ecosystem, and on their own protocols, and that's the beauty. So the Uniswap source code is open source. If you have the capacity to read, understand it, and then clone parts of it, you could probably deploy it and maybe use it on other chain, on an L2 and things like that. Excuse me. So we can have a small talk on how Uniswap came to be. So after Vitalik Buterin posted a blog post in 2017, Hayden Adams. So Hayden Adams is founder of Uniswap. So probably you can research about him on his blog. So this man was inspired to try to implement Vitalik's idea in what eventually became Uniswap. After spending over a year working on the code, Hayden finally announced a launch of Uniswap V1 in November 2018. Of course, there was a team, but he was the lead. So November 2018, that's when the first version of Uniswap was announced. I think I can share some of these in the Telegram, where you can in the group where you can read about it. I think there is a lot to talk about today. Probably those on site launch something great. I think they'll really have time to, tell us, about their launch. It's exciting. I don't know whether I have it today here. I think I have his search. So I can't find it right now. But I think I can really second to see if I can. think this is enough info. I failed to get that blog, but there was a blog, the first announcement of Uniswap. So we are really going to be talking about this in detail, like things like Uniswap. What does it mean to be a decentralized, an AMM, like automated market maker? Yeah, because one of the challenges we find is we are not part of the we are not part of the revolution. Okay. So one of the issue I would really find is that we are not so much involved into the revolution of market making, things like trading that happened in Web2 as the global south. So you find out that I think it's good to dig this matter a bit deep and see what leverage and what advantage we have, and how we can really approach this. So what exactly is the problem that we have? So for example, if you want to trade with one person, maybe you want to exchange a token, the quickest way would be having probably a centralized exchange, maybe bringing a centralized exchange on chain. Yeah, so that probably whatever exchange you make, maybe there is a recording of all the aggregated transactions that have been happening on chain. And while that would really be something, we're going to see some shortcomings. So centralized exchanges typically work on an order book system. Let me say, so they work on an order book system, and what we mean is if you've done some trading, or if you haven't done trading yet, they use what we call an order book. So let me say person A, I could say, let me say Alice. Maybe puts up a listing saying that she wants to sell 100 of token A, probably token A. So this is how the order book way typically works during trading. For 50 of token B, for 50 of token B. So, and if there is someone that adds at some point, let's say Bob. Bob owns token B, and Bob says I have 50 of token B, and I want 100 of token A. And I need them for 100 of token B, and then their orders match. Then that's when the trade is executed. So an order book simply is taking records of every order input, and then every order input by party A and then party B, and those orders that match are executed. So initially we had order book exchanges like OX. OX had a good API some time back. But again, this really did not work out due to the high gas fee. So as long as there is high gas fee, of course, attraction to users really, was reduced, because you required to store, you required a lot of storage for all these matching algorithms, and also it was really challenging to execute them in an order book manner, because if for any order input you require an on-chain signing that would change a smart contract, then a lot of gas was being used, and this was really not so optimal. So there was a need for a new approach, a way to allow users to swap between any two tokens arbitrarily without needing an order book additionally. Yeah. I think knowing about order books is one of the good things that can help you know about the financial markets. And yes, I encourage us, to always participate. We've gotten something that is really good. For example, the Web3 puts a leveled ground. So we know that financial markets for example, shares they start in the morning and then close at night. But the crypto world does not close, so does not sleep. So, and then it gives us the same leveled ground. Whether somebody has a lot of liquidity or you don't have liquidity, or you have low liquidity, yeah, you can try out many things in the Web3 ecosystem, and yeah, there's that leveled ground. Probably you could just keep maximizing on the knowledge that you're bringing to the field, so that you optimally benefit. Yeah, so trying out things like exchanging, things like flash loaning, which we shall see. Yeah, it is, even if we don't see it, you can go and research about it, but it really gives us some sort of leveled ground, and also an opportunity to participate directly in financial markets as the global south. So yeah, there was really a need for a new approach, a way to allow users to swap between any tokens, any two tokens arbitrarily without needing an order book additionally. So cookie points, if users could actually earn money by using Uniswap. Okay, we are going to, I think, let's go a bit deep into the Uniswap versions, and shall do some calculations as time goes on. So let's tighten our sweet bolts. So let's have just a small, talk about Uniswap evolution. We have Uniswap V1, V2, V3, and now V4. So you can get a copy of Uniswap, probably Uniswap V2, and create your own DEX, probably out of it, or optimize it to meet your own, requirements. Yeah, and put it in the decentralized world. So I think at this time, there are now 4 versions of Uniswap that have officially been announced. And V4, I think, was deployed or isn't deployed yet to mainnet. But I think if not, all the code is available on GitHub. So the first version of Uniswap, V1, was launched in November 2018 and allowed swaps between ETH and an ERC20 token. So if you had ETH and any ERC20, so first version of Uniswap was launched during this time. And yeah, that's when like it started. So also chain swaps were also possible to allow for token to token swaps, such as going from token A to token B by first converting, one of them to ETH and then using ETH to buy the other one. So if I had, I wanted to swap between token A and token B. Let me just get, okay, I think this works. So if I needed a swap, I could get token A. To ETH, then from ETH to token B. So yes, this is how I would do if I wanted to move from token A to token B. So these are called chain swaps. I think that's it. Yeah, so that's how it all started, in around 2018. Then Uniswap V2, so the V2 came about in March of 2020. Really, these need an extensive research on the smart contracts, because these Uniswap versions are just smart contracts and the backend is fully smart contracts. And yeah, if you can take your time, it's amazing to look through the logic, the math behind and everything. So yeah, V2 came out in March of 2020 and was a huge improvement over V1 that allowed direct swaps between any two ERC20 tokens. So the addition was that token A to token B was now very possible as long as it were ERC20. So this was possible. It was no longer token A to ETH and then ETH to token B. Oh. So yeah, if a direct pair of some token was not possible, then this route would be token. So that addition was really very good and required. So V3 came out in May of 2021. We had V3 coming out. V3 Came out in May of 2021. And yeah, so every version comes out for a reason, and you can find the source code of any Uniswap version on GitHub. It's open source. Yeah, if you can make good use of the code. So it came out in May 2021 and improved capital efficiency, which allowed the liquidity providers to remove a big portion of their liquidity from pools and still keep getting the same rewards. You know, recent we have gotten things like Hagen Layer, where you can get rewards from your tokens that you staked somewhere else. So some of these improvements came out mostly, for example, in Uniswap in 2021, where if somebody deposits some tokens, you know, they can be given something called LP tokens, which are liquidity provider tokens. So for those of us, I see a Tracy who are planning to invest in this. You can become a liquidity provider. So then, of course, Uniswap V4 came out in June of 2023. So you can say V4. So V4 came out in June of 2023. And allowed for custom hooks to be added to pools, and also a singleton Uniswap contract to manage all pools on the DEX, thereby reducing gas costs and allowing more customizability of the different pools. Really, I'm still also a student of Uniswap V4. Yeah, but we are going to look at the fundamentals. So you can go on Uniswap V4, maybe ad hoc, like maybe probably build a front end where people don't need to go to Uniswap but can have exchange of tokens from your website or from your front end, yet you're having the API from here. I think, do they have an API? I think they have. Yeah, so yeah, you can look at the docs. I think Uniswap docs. There is docs for V2, V3 docs, and why not? You can really create something, you know, from the documentation, see what you can build, and yeah, never know, you could be earning, you know, some of the gas fee payments from the traffic that is coming from your website. Okay. So I think, yeah, we've talked, and for the purpose of this lesson, let's focus on the design of Uniswap V1. Yeah, let's go back to where it all started, so that we can have I don't know, is this kind of also teaching with this board good? How do you find it? Oh, I'm really not utilizing the board. So yes, let's go to the focus, and yeah, so Uniswap V1. We are going to look through really how does it come for it to be called a decentralized exchange? What does it mean? So that's going to be our focus. But as we are going to focus, we know that we are looking at market makers, those who determine the prices of markets. Yeah, I'm looking at Prime Manuel here. Yeah, it's just a matter of time. So as you've said, Uniswap is an AMM, and we are going to be breaking that down. So what are market makers? Market makers are entities that provide liquidity or assets to trading markets. So in non-order book systems, liquidity is what allows trading to be possible. That means if you want to sell, for example, BTC to buy ETH, the exchange must have an ETH balance. You can purchase from in the exchange for some BTC. So for example, if I want to purchase some BTC, first of all, the market should have that BTC that I want to purchase from, and then so that transaction is possible. So I want to purchase some BTC, and then I have ETH. So that means that the exchange, whether it's a centralized or decentralized, should have this amount of BTC for this to be a possibility. So, and that for some trading pairs, they have very high liquidity. Basically, maybe because people can buy in huge amounts, let me say ETH, BTC, and some other have extremely low or no liquidity at all, e.g. some scam tokens, maybe a token that you've just created, an ERC token that you've created, could have low or no liquidity. So a DEX must have enough liquidity to function and serve as an alternative to a centralized exchange. And the reason why it should have this enough liquidity is because at whatever moment a user or a trader comes to exchange between those tokens, the pool should have slightly more or more than what the trader wants to take out of the liquidity pool, want to exchange for out of the liquidity pool. So market makers are entities that provide liquidity, as we've talked about that, or assets to trading markets. So one way to get that liquidity is that the developers or the investors put in their own money and become market makers. However, this is not realistic. We know that, as they would need a huge amount of money to provide enough liquidity for all possible trading pairs. Moreover, this hurts decentralization, as we know, as the developers or investors would hold all the power in the market. This is why the blockchain is very interesting, because previously many exchanges, the owners of the exchanges or the investors use them to just hold their amounts of money. But with the birth of decentralization, you can be a liquidity provider with $20, $30 and pass through that experience of what it means to provide liquidity, how you earn, and things like that, so that it broadens your brain and also exposes you to such opportunities. So another way which Uniswap of course implemented was to let anyone to be a market maker, and this is actually what I've been talking about, and this is what makes Uniswap an automated market maker. The ability that anyone can come into Uniswap and provide liquidity for a given pair or take out liquidity. What I mean is, if you exchange for, say, this, I don't know, all these tokens, these tokens have liquidity in them. So that means that you can also create a token, let me say this token, and then come to Uniswap, add it and give it liquidity of a given pair. For example, you can give tokens liquidity to your token as well as liquidity to Ethereum, so that anyone coming to swap between your token and Ethereum finds liquidity that is more than the tokens that they are swapping at that time. And yeah, that's how it is. So I encourage us, if you've created an ERC20 token or some token, you can take it to a DEX and then provide liquidity for the two token pairs, the one that you would want to exchange it to. If it is your token versus USDT, your token versus ETH, yeah, you provide liquidity for either ends. Okay. Any questions? Any additions? Compliments? What do you feel about this topic? Let me get some feedback. Am I moving so fast? Hello, Pod Damba, Decentral Code Journey. It's amazing. So, yeah, I want to get your feedback. Tracy, is what I'm saying a bit understandable? We have people who did the con. All right.
Okay, I have a question. Am I audible enough?
I can hear you. I don't know if others can hear you.
Okay, does that mean if I'm going to be a market maker, I have to provide liquidity for perhaps two tokens? If I'm providing liquidity between maybe BTC and USDT, I have to provide liquidity for both BTC and USDT.
All right, that's a good question. So if you already found when there is a person who initiated the USDC BTC, as somebody initially provided the liquidity for both tokens, you can provide liquidity for one of the tokens. Yeah, you could provide a liquidity for one token, but take a scenario where USDC BTC token pair does not exist in the Uniswap liquidity pool, then you have to provide liquidity for both of the tokens. Does that make sense? All right. So we are 18:11. I think at around 18:13 we can resume. Let's take a breather. Let's chat a bit. The silence is top notch. It's only a thumbs up. All right, I think we can continue. So as we said, the way Uniswap implemented it was to let anyone to be a market maker. And this is what makes them, an automated market maker. And that means that anyone can add liquidity for a token pair, and anyone can remove liquidity, and anyone can come and exchange between the two tokens as long as you have the ability to pay gas fee. So why would you probably do that? Maybe provide liquidity. In exchange, you really earn money for doing so through the trading fees taken from the users who come to do exchange. Yeah, so you really a share between those trading fees between the DEX, the protocol, and you. So you have a cut. So that is one of the ways a liquidity provider is incentivized to provide liquidity. So we can take it a bit further and look at the functional requirements. So far it has been fancy talking about it, but then what do we need to make this a reality? How should we make this a reality? So at least to build one automated market maker, an we need to at least have some of these functionalities thought about. One is anyone can add liquidity to become a liquidity provider. So yes.
Yeah, there's something I just thought about. So, in situations where there's supposed to be price fluctuations,
Yes.
perhaps for tokens that are volatile, what's the mechanism that an AMM would use to keep modifying the prices according to the standard market price so that there's no loss that is incurred in these exchanges that are being executed on a decentralized exchange?
Okay. I think as we move on, that question will be answered fully. Move. Their liquidity. But that is a good question. And get back. Your crypto whenever they want. So users swap between assets present in the trading pool. There is enough liquidity. Then the fourth one. So these 4 characters would make Uniswap an AMM fundamentally. So scan charge. Small. So I think these would fundamentally don't know how this came about. Okay, so I think we can leave it at that, but that is it. So one is anyone can add liquidity to become a liquidity provider. So liquidity providers can remove also their liquidity and get back their crypto whenever they want. The third one is users can swap between assets present in the trading pools, assuming there is enough liquidity. And then users can be charged small trading fees that gets distributed among the liquidity providers. So here they can keep being incentivized to keep their money in these liquidity pools. So when we have that, I don't know if you people have gotten this. I don't know how this came about. So we can look at the equation of Uniswap. So x is assigned to a constant k. So at the core of the Uniswap v1 is this equation. And things are getting a bit more interesting, requiring a bit more attention, because we are starting to have the math, and some of this math will answer some of the questions that Manuel had. So if we are to go through this, taking an example of a trading pair between ETH and token. So let me see, we have ETH. And another token, probably we are going to call token. So we need to exchange between these. So with this equation, x will be assigned to the balance of ETH, of course, in the trading pool, and y can be the balance of token in the trading pool. And then k is a constant value. Yeah, so that's the equation that is underlying Uniswap V1. So that means that if this is a multiplication, it doesn't matter whether x is the token or y is the token, because it is a multiple. So if I exchange y times x, it will have the same implication. But what we must know is that x is the balance of ETH in the trading pool, and then also y is the balance of token in the trading pools. So these are all balances that are in the trading pools. Then k is the constant value over which the trading will come. So this formula states that k is a constant value no matter what the reserve balance of x and y are. Every swap that happens increases the balance of ETH or token and reduces the balance of the other. So let's represent a swap being made as an adjacent to the formula. So for example, if you have to swap from x to y, that means that x will decrease as y increases. If you have to swap from y to x, that means that you have more of x, and y will reduce by the more that you have in x. So if we are to use that as okay, so if I take this as equation 1, and then so if I have a swap, I can have x plus the increment to do dx y minus the increment in y will have equal to that same constant k. These shapes are really somehow making my life easy. So this is equation 2. Okay. So in this case, X will be the current balance of ETH in the trading pool. And then Y will be, of course, current balance of token in the trading pool. And the change in X, which is dx, is the amount of ETH being swapped into the pool Hope everything is still very visible. And this is the amount of token that will be swapped out of the trading pool. So we started by this formula that at the core of Uniswap you have the balance of ETH in the trading pool and times the balance of the token in the trading pool should give you a constant. Let me say this token is 1-to-1 with ETH and I'm swapping between token and ETH. That means that when I have a multiplication of both tokens, I should have a constant of 1. No, I should not have a constant of 1, but the constant comes when I multiply both of the tokens. Maybe I can repeat that. For example, 1 as as a swapping, as a, as a one-to-one, let me say one-to-one swapping detail was gotten from multiplying the amount of, was it dividing? Okay. This one may not bring it well. But this equation implies that when you multiply the number of tokens you have in the pool of a given token A by the number of token of a given token B, you have to get a constant. So this was made as the assumption onto which Uniswap v1 and actually the Uniswap versions sit on. So in any case, if you are assuming you are swapping from one token to another, that means that the token you are swapping from, you are deducting some tokens, and then the token you are swapping to, you are adding some tokens. So just getting this same equation that acts as the fundamental, and then adding the increments, all subtracting from where you are getting it, then you again get this same constant. Any additional or increments, or we should go on? Yes, Code Journey.
Yeah, my question is about this constant. Does it represent the exchange rate, or does it represent the relative percentage of existence in the pool of the different tokens that are being exchanged? Does it represent the percentage of each token that is left in the pool, or the rate at which they can be exchanged in a particular time?
Can you please repeat?
The constant that you get by multiplying two tokens.
Yes, which is K.
Yes, its representation is not clear to me yet. Does it represent the rate at which they can be exchanged? Because in that case, then there needs to be a method of accounting for changes in value for any of the tokens. Or does it represent the percentage, the amount that is left by comparison, the amount that is left in the pool, comparing the two tokens, the amount of value left in the pool for either of the tokens?
I think it represents a thesis. So sometimes if you want to establish a rule, let me say in mathematics, you have to start from somewhere, because you cannot say it represents the amount of tokens left in the pool. It could, but maybe the tokens left in the pool would have been x plus y equals to k, but it was used as a basis to provide, like, as a thesis, to provide the base of coming up with a mechanism to establish a decentralized exchange. And one of the actually challenges of that we have, it's not a challenge, it's a challenge and also an advantage, is that the term itself, DeFi, was coined after Uniswap was launched. So the thing called decentralized exchange was brought out by after they were changed. I think we probably have to do more research and see why they chose to start with this equation as their base. Did it depend on? I've read some small notes about the founders of Uniswap, that they were all working in the banking sector, but I think it's something that we can research about. I think I've not answered, or I've answered, I don't know.
No, the answer wasn't very clear, but I think we'll do more research, like you said, because just to put it out, perhaps for everyone to understand the point from which I'm coming. Just imagine we are exchanging ETH with some other volatile token, perhaps Cardano. The truth is the dynamics that control the price of Cardano and the price of ETH will drive the prices of both these tokens in different directions at different times. So at a particular time, the exchange rate between Cardano and ETH will keep changing. So there needs to be a way in the market maker, in the AAM, for you to track these changes and be able to establish executions of exchanges at a price that is close or somewhere relative to the current market price of these tokens. So how that change is established, how that change is tracked and implemented into the dynamically implemented into the exchange, that every time you're exchanging between Cardano and ETH, either from ETH to Cardano or Cardano to ETH, you're not using a price of either of them that is previous and perhaps is incorrect and could incur losses to anyone that invested their stake into the pool.
Okay. I think some of the statements you hinted on are going to get answered as we establish this. As we have this established, and then we get to realize what makes these tokens not to be depleted fully from the pool. One of the truths is that the initial person who provides liquidity has a lot of power over the exchange and how the token and the token direction that the token could take, and also the amount of liquidity can greatly impact. Then others who add liquidity follow the trend that has already been set. But let's see how we can derive that mathematically. So as we have said that the change in Y is the amount of token that will be swapped out. So, and we started by saying these can be interchangeable depending on which token is being swapped in and swapped out. So X is the current balance of ETH in the trading pool. Y is the current balance of token in the trading pool. The small exchange in X is the amount of ETH being swapped into the pool. That means that I have maybe 100 of token and I want ETH. And then dy is the amount of token that will be swapped out of the trading pool. This can also be, can also be represented in a smart contract format. But for now, let's look at the math and then come back and if we have the time to look into the way to represent each stage on the smart contract basis. So I think we can start by so with these two, we can get like the change in Y, which is dy, but maybe probably we could have some question. So, question. So, assuming we have 100 ETH and 200 token. In the trading pool. So from the above expression, how much of token would be swapped out for 1 ETH. So this is our question. We can give it 6 minutes, 5-6 minutes. At 50, we come back with answers, and then yes, anyone? Yes, Maria. So amount was 0.02 tokens. Okay. Any other person? Code journey. You people did from the same?
Yeah, we worked on the same paper.
All right. So I think I can reduce this by. By this. Let me see. This will really help. So if from equation 1, if I want to eliminate k, when we subtract let me say 1 minus equation 2, we shall have xy or x star y I think even not 1 minus 2, but replacing k with x star y. So let me say and this will be simple. Replacing k in equation 2 by x star y or xy we can have x. If we start multiplying this x times y, okay, we can have x. Let me put it in bracket step by step. So we shall have x plus dx times y minus dy being equaling to x star y, x times y. Is that, like, are we at par with that? So, yes, are we at par? You can give me a thumbs up. Okay, let me just continue. So this x times y will have x star y, which we can take as xy. So this x times this y, then x times minus dy, so minus x dy, then plus, so we have dx times y, so which is y dx, then dx dy minus dx dy will be equaling to x star y, which we've taken as xy. Just expanding on the equation. So since I want to find the value of dy, I can have all values that have dy on one side. So let me bring this xy, this one, to the left. So I'll have the first xy. When a positive crosses, it becomes a negative. So minus xy. Then we can take all the dy's on one hand. So we are going to say plus y dx. So this minus x dy will cross and become a plus. So x dy. So the minus dy dx will also become a plus dx dy. Is that very clear for us?
Yeah.
Okay. So this xy dies with this one, and you have y dx equals to x dy plus dy dx dy. So our aim is to remain with dy. We can have y dx is equal to, so we can remove the dy, and then here we shall have x plus dx. We have factored out dy. So if we divide both sides by x plus dy, we remain with dy on one side, being equaling to y dx divided by x plus dx. So this is dy is the amount that will be of token that will be swapped out of the trading pool. So if we come here dy and then we fill in, or even if we had filled it in here, we would have gotten or here, like at this point, we would have gotten the same answer. But then our x from this question, so x, the current balance, say the question says assuming we have 10 ETH and 20 tokens in the trading pool, so both of the trading balance in the pool are this. From the above expression, how much of token would be swapped out? That means if we bring in 1 ETH. So for that we have x being equaling to let's say So we said here that dy swapped out. So that means that x plus dx was the ETH. So x is 100, and then dx equal to 1. Then y is 200. Tokens. So from here we can have dy equaling to, so y, which is 200, divide by x, which is 100, dy equals y dx. So it is 200 times 1, okay, which is 1, okay, times 1, divided by 100. So which answer do you get? I think it's around 1.98 tokens, isn't it? So I think this was wrongly gotten, but even if we are to fill it in this, maybe we said this equals to this and then we just fill in, would have ended up with something 1.980 something. So this is becoming a bit interesting because you suddenly realize that it is not just a place where you're going to come, put and remove and remain with zero balance. Actually, this is bringing a hyperbolic curve, but we can look at maybe question 2 and so I think we should erase this. How did you get to this answer? Maybe you can share. Or we just continue. I'm not hearing, okay? Yes, your microphone is on. And I think the volume of your computer is low, but okay, it's good we have seen the working. So we can have a final question, I think. So let's say this time we have input token. Let me see, input amount of 2 tokens. And then you have input reserve 200 token. And then you have an output reserve of 100 ETH. So let's calculate the amount of ETH that will be swapped out of the trading pool. Should we always write the solidity code along of how these things would look like, or today we first look at calculation? What are your suggestions? Are we done?
I think the answer is 0.998.
So here the answer is so the answer is 0.998. Okay, so I think this is correct. Yeah. So you quickly realize that with this, you can find K, or so let me say I want to remain with K. So you will find out that actually now K can be gotten from such also of such expressions. But the funny bit is this results into amounts that are very close, 0.99 and then 1.98. So something like 1 to 2. So it's like 1 to 2 ratios of token present in the contract reserves. Yeah, so if you actually draw a graph, you'll find out. So if I draw out a graph from the equation that we saw earlier, x star y equals to k, it becomes a hyperbolic graph. Something of this. I don't know if they have a curve. Okay, I think I can have a curve. This is undo. So I don't know whether I have a curve element. If I don't have a curve, I will see how to represent it. So I really don't see a curve here. So, but the curve is hyperbolic, and what we know about hyperbolic curves is that they don't meet at 0 point. So let me see if I can get I hope this doesn't take time so that we can continue. So I think with that we can continue, just knowing that the result from that is an hyperbola, and these never intersect at x equals 0 or y equals 0. So that means that neither of the reserves can ever go back to 0 just by swapping tokens. So the reserves behave infinitely in this way. Actually, let me draw that curve and let me show let me give it time because I think that statement is really crucial. My internet is taking some time. Okay, let me see here. So I don't know whether this allows to bring in some pics, but I think I can show it here. Yeah, so the hyperbola really looks like this, and wherever you feel any digit in this, in the value of x and the value of y, the shape that comes out is this shape. I think that's the reason they started with the equation of x star y is equal to k, so that for any swap, you don't get an instance where you have zero balances. So there is no time you will have like zero balances of the other token, because if you're swapping more, you tend to just go to near zero, but you never get to zero because of the nature of the equation. That's something very profound in this token. So the people who have a lot of power are the people doing putting in like the initial tokens, the initial token pairs, and are setting up that trend. So others will add and others will swap, but even when you need all the amount, you cannot deplete the other token due to the mathematics that was used in forming the DEX. Yeah, and that causes introduces to some new topic called slippage. So since we don't get tokens in the exact ratio of reserves, we've seen that someone asking something. Okay. So since you don't get tokens in the exact sort of, it's not a one-to-one that if I give him A, 2 of A, then they might give me 2 of B, but it is according to a mathematical equation which leads to a hyperbolic sort of behavior. It leads to very many interesting implications of the math. The price function causes slippage in the price. And that means that the bigger the amount of the tokens being traded relative to their reserve values, the lower the price would be. So if you minted a billion tokens, and then you have like $100 worth of reserves, that also implies on the token. So the token will really have lower value. But if you probably mint 100 tokens and maybe you have $100 worth in reserves, probably exchanging that token to ETH, maybe in each of the token value, then that would highly translate into the worthiness of the tokens. Yeah. So let's say I wanted to try to drain out the entire pool and sell the 200 ETH amount. So can we go and probably do some of such a calculation? This we are going to be quick. So let me say I wanted to drain or sell all the 200, sell all the 200 ETH that we add from above. And then my input reserve is 100, of course, ETH. 100 ETH. And yes, we can talk about output reserve as probably 200 tokens, as we've seen. Not output amount, but output reserve. So I want to look at a scenario where I want to sell out all my ETH. Will the reserve remain empty? So out reserve, if it's 200 ETH, the 200 token. So what would be the output amount? So we have 200 ETH, 200 token as output reserve. And then we have, 100 ETH as input reserve for the ETH, and input amount of 200 ETH. What would be the output amount for the tokens? If you have gotten the answer, you can share it. Which answer have you come up with? So, any answers yet? Should we first continue? Mr. Tumusebe, you're welcome. What page are you on? Paul Damba, the silence is really. Are you getting the concept? Yes, Maria. I think your volume is very low. I don't know why. All right, I can hear. Yeah, but your volume seems to be very low. All right, so the answer is 133. 33.33 something. Yes, I think that's the exact answer. So when we look very closely from up, we started at assuming we have 100 ETH and 200 token in the trading pool. From how much token would be swapped out for 1 ETH. Now, assuming we want to swap out for 200 ETH, you realize that if it was just a linear sort of thing, with the input reserve of 100 ETH and we want to swap out 200 ETH, you'd quickly think that the 200 token would be like depleted and then there would be no swap. But it is interesting that for the 200 ETH you would need 133.3 of token to swap out. And this kind of phenomena comes from this kind of behavior. That initially as you move from the zero line, the linear bit becomes sort of hyperbolic. So the more you want to swap out, you will not get to that zero mark. This is almost like half of 200 tokens. So from that concept, that's where things like arbitrage were born, because most of these concepts are in the Web3 space, in the DeFi space, but they are not in the normal, centralized systems. They're not in the banking way of doing things, because these concepts were invented due to the liability that comes with doing things on chain. Yeah. So some may see that above thing as a flaw of automated market makers that follow the X times Y equals to K, but it is actually not. It is the same mechanism that protects pools from being completely drained. This also aligns with the law of supply and demand. The higher the demand, still on this curve, I think, the higher the demand, the higher the demand relative to the supply, the more costly it is to buy that supply. I think we shall take time to read through this, but at least for now we have a clue. Yeah. So now the big question is, who sets this initial supply? Are we really going to do some back end after this? So who sets this initial supply? And when a new cryptocurrency is created, there is no liquidity for trading pairs involving that token. You know that you've created your ERC20 token, ERC77, you want it to be worth, some $5 per token. But after creating it, all you have is a smart contract on the blockchain, and there is no liquidity for trading pairs involving that token and any other token. So as such, there is no way to calculate the price for it. Therefore, the first person adding liquidity to the pool gets to set a price. Adding liquidity involves adding tokens from both sides of the trading pair. You cannot add liquidity for just one side. So when the first person adds liquidity, maybe it is you, the creator of the token. It creates a reserve balance and sets the initial X and Y values. From that point onward, we can do price calculations when swapping between tokens. A simple implementation of the add liquidity function in Solidity. I think I can really share those functions, but I feel like it is overwhelming. Should I keep? I think I should first leave them out. Maybe when we come to, what's your take on it? Should I keep sharing those functions so that you see how we initiate those in the, okay. Yes, Mr. Paul.
Well, I think you can share the functions too.
Okay. So the first function we had, my screen is visible, or I should, let me see if I can use the right one, sorry. I think this is better. So in some of the upcoming classes, we are going to really do some good thing to do with Foundry. Be doing some practices of probably whitelisting addresses, things like having exclusivity for a launch of probably some NFTs. The first function, I think, was the one where we had the change in token Y. I don't know if this one allows it as a equaling to ydx over x dy over x plus dx. So I'm going to call this as a function name dot sol. We're explaining on how can you write depict such a thing. So if it is a function, be like function, I think calculate So based on the equation, we shall have a int input amount and uint input reserve. Also we had uint output reserve. I think these were the variables, so we want a this function to return dx dy, which was the, I think, the output in exchange. So the return will be a uint. So it's really somehow interesting when you're turning math into code. So uint output amount will be assigned to so output reserve input amount plus input amount. So the function would look like this actually, and then we have a return. I think we return the output amount. Okay, so when we are to look at here it has turned it into a function, but we've gotten the gist. So if we are to look at what we've been talking about to implement the add liquidity function in Solidity, I think we have really done a lot of add liquidity. I wanted to start having a rise. Is it called a rise pad? Let me see if I can call it a rise pad. Yes, I think it is rise up pad.riseup.net. So pad.riseup.net. So I think I have a lot of code. I create a pad rise up, okay. So with the rise up, with the pad, you can keep adding like code, and then people can come back and look at it, and then so if you want a part to be deleted after one day, append the word TMP. So let me put, I think, this intro code. I think we are going to really be using this part from now on. So probably I can just copy from where I have this code in. So you can have your name. Today let's start with type of attendance. So probably if you are on site or online, you can say Kakuza. So this is the part link. I think it will really keep us engaged, and also we shall have a place where you can come back to, and so this pad will be off like in 60 days. So pad.riseup.net/p/decentralcode. I don't know what is the date today. Yeah, because in the coming future we're really going to have like huge pieces of code. Maybe I can say on-site. So you can tell us whether you are online or on-site in real time. You can actually also track those who are really available. I'm waiting to see names. Copy the link, add your name. Let's continue conversations. You just press enter here. Name, on-site or online. I'm not seeing anyone typing. Is it a new thing that you've not used it before? Please use the pad. Learn it as you're using it. All right. Sometimes it doesn't load on Google Chrome. So if you have other browsers, I think mostly Firefox, it's very good with Firefox. I remember my first experiences with Chromeware. Yes, I request to write like below Kakoza. So name, you just write below Kakoza, then this other field, I'm going to use it for pasting code. Let me even put it down. Okay, thank you. So from here you could come back to the codes in the pad even after the lecture. So it will be really very amazing. And yes, so yeah, I think this is how I will do it. Maybe I can put start. And then we have end down here. Yeah, that's amazing. So most of the code, you can come pick around that code. As we shall continue having too much code, we shall paste and then go through it. Yeah. So we're looking at how it could be, for example, to write a function that deposits liquidity. Here the stat is not here, sorry. So for such a function, if you had to write it, for example, in your own DEX, so you have a function add liquidity and then the token, of course, token amount is like how much you're going to add, public payable. But most of, I think right now, adding pairs, adding liquidity to your pairs simply needs you to have the smart contract. And then I think there is a normal just buttons to add. Yeah, so token.transfer from, of course, we have seen msg.sender, which is the deployer, and then address this, then token amount. So I think this we have seen, and we can keep continuing from there. This is proving to be more efficient. So this function accepts the ETH and a token from the user. However, this implementation is incomplete, as we have seen. So a second person can come along and add liquidity in a completely different ratio of reserves, which would massively affect the price calculations. We do not want to allow for such price manipulations, and we want prices on the decentralized exchange to be as close to those on centralized exchanges as possible. So we must ensure that anyone adding additional liquidity to the pool is doing so in the same proportion as they already established in the pool. We only want to allow arbitrary ratios when the pool is completely empty. As Manuel was really asking questions about, like, how do we make sure? So as soon as the first person who adds the liquidity of the pairs establishes a ratio, then other people, the pool will always regulate that equilibrium so that other people adding liquidity, their liquidity can be brought to not to surpass so much away from the initial ratios. So if it is an implementation in the code, it would be something like this. I think after MMMs we should maybe stop there. And yes, Mr. Manuel.
was saying that if someone establishes an initiation, just a moment, please. Yeah, sorry about that. So you're saying that if someone establishes an initial ratio for exchange of two tokens in a liquidity pool, the subsequent liquidity providers should follow the same ratio. Am I getting that correctly?
The subsequent providers do what?
The subsequent providers, liquidity providers, should only provide liquidity following the ratio of the initial deposit into the pool. Is that correct?
So yes, the initial provision will give us like a new value for K. So that K will keep regulating back that. For example, the subsequent provider might choose to only provide liquidity for token B, and then there is much of token B and less of token A. Even with that, because the K value was established by the initial liquidity provision, it will not sort of over make the token be like lose value. I don't know whether that could that makes some sense.
Yeah, it does make sense. My concern is if I'm dealing with a volatile tokens that are bound to change depending on dynamics of supply and demand, how do we ensure the AAM will keep track of all those changes? Because from what I'm seeing, the K seems to be kind of like the exchange rate. It establishes the rate at which these tokens can be exchanged. But that rate is bound to change as the tokens keep changing in price individually, independently. But how would it be established in the cases where we're exchanging perhaps ETH and another volatile token like Lisk? The difference in the exchange rate between ETH and Lisk is bound to change at different times depending on different things. So how do we ensure that right now we can exchange between Lisk and ETH at a particular price which is close to the market price, and then maybe 2 weeks later when Lisk has appreciated in value, like maybe 1,000%, we could still exchange it using the same AAM and have accurate exchange rates.
Okay, that's a good question. So one of the things, the AMM structure is one of the things, and actually, this was V1, but there are many other things. For example, you see, the real supply of the token also must matters. So you could find that, for example, Lisk is at this. I think it's not a good coin to use, but for example, Lisk is on at this amount of dollars, and then they are minting. It is inflationary, so they are minting more tokens. So that would really change the supply and demand curve. And that minting might be like automated. That, for example, if Lisk value is exceeding, let me say, 1.5 token, 1.5 dollars worth of ETH, mint more Lisk tokens to take back the price to probably 0.5. So that could be the issue. So you realize that there are really many given issues that can be around, yeah, a token. So it's not just the K value, but also the supply and demand. Also, the other thing, if people are really taking out that token, that means surely one of the curve is one of the other end of the bargain is really uh, maybe if they are taking out, like, for example, the other token they are swapping to, let me say the token is Lisk and then they are taking out their ETH in the pools, it means based on the supply and demand curve, they are pulling the value of Lisk down. Yeah. So because the more liquidity of one would implement hyperbolically the more liquidity of the other. As people pull out liquidity, also this comes closer, and you realize that at this 2 mark, it's like a straight linear sort of exchange, 2 3. But then, yeah, let me stop it at that. I hope I've explained something. So I've lost track of where we are, but I think we're in the raise pad. So function to add additional liquidity. I think by that the raise pad will become something good. If we have like some huge smart contracts, then we can. Is there someone outside? Malinga wali omuntu wabweru. Tewali. Aje tewali aliwo. Oh, thank you. I'm sorry for that short, So we can continue and see how we conclude on this topic as we looked at the V1 of the Uniswap. So we have looked at many things, but then we can look at something called LP tokens. So LP stands for liquidity provider tokens. We are excited to see people launching tokens, ERC20 with real liquidity. So far we have discussed how to add liquidity and how to do price calculations for swaps. But what if a liquidity provider wants to withdraw their liquidity from the pool? So we need a way to reward the liquidity provider if there are many providers for their tokens. As without them, other users would not have been able to perform swaps. So yeah, nobody would put tokens in a third-party contract if they are not getting something out of it, of course. So how do we reward these liquidity providers? So the only good solution for this is to collect a small fee on each token swap and distribute the fees amongst the liquidity providers based on how much liquidity they provided. So if someone provided 50% of the pool's liquidity, they should receive 50% of the fees. I think that's something that makes sense. Isn't it? I'm looking at liquidity providers here. All right, so there is quite elegant solution to do this, and it's called LP tokens or liquidity provider tokens. So LP tokens work as shares. You get LP tokens in exchange for your liquidity. So let's say you provided 20 ETH and 20 ETH is worth 50% of the liquidity pool. So they will give you the liquidity tokens which are worth your 20 ETH or which are 1-to-1 with the 20 ETH. But in terms of shares, so amount of tokens you get is proportional to your share of the liquidity in the pool. Fees are distributed proportional to how many LP tokens you own. So LP tokens can be exchanged back for the liquidity plus the earned fees. But of course, there are other additional requirements. One is issued shares must always be correct. When someone else deposits or removes liquidity after you, your shares should remain and maintain correct values. Writing data to the chain can be expensive, so since every time people are writing data when you remove, so we want to reduce the maintenance cost of LP tokens as much as possible. Since these are just a representation of your shares that you have as a means of you providing liquidity token. So let's say, imagine we issued a lot of tokens, say a few billions. The first time someone adds liquidity, they own 100% of the liquidity in the pool. So do we give them all the few billion tokens? I think this is not ideal, because this leads to the problem that when a second person adds liquidity, the shares need to be recalculated, which is expensive due to gas fees. So the alternative thing would be if we choose to distribute only a portion of the tokens initially, we risk also hitting the limit, which will also eventually force us to recalculate existing shares. So the only good solution, not the only one, but the best I think out of them all, seems to have no supply limit at all and mint new tokens whenever the liquidity is added. So this allows for infinite growth, and if we do the math carefully, probably the math is based on the minted tokens to divide the shares. Yeah, we can make sure that issued shares remain correct whenever liquidity is added or removed. So, do we calculate the amount of LP tokens to be minted when liquidity is added? So the way Uniswap V1 used to do it is that Uniswap V1 calculates the amount proportionate to the ETH reserve. So I think we can look at this equation and then for V1, it uses this mechanism to distribute the LP tokens minted. So sometimes you go to an exchange and then maybe a lending protocol, and then you provide a native token or USDC, and then they give you their token in your wallet. So that is like an LP token, and the amount that is accorded to you is mostly based on this formula. Some can change because people get this code and maybe modify it. Yeah, but that is it. So we can update, of course, add liquidity function to mint LP tokens when liquidity is added. I think if we want to also have a look at that in terms of code. So So we have start and then end here. So the good thing with the rise part is that you can come back. I think the date today is 3rd, so we can. This can also be something we can use probably to mark and see. 2025. So yes, so you'll find that, for example, we have a function add liquidity. So the amount that we have to add, and public payable means that this function can receive, can receive ETH or amount. So if the get reserve is 0, then you are adding liquidity initially. Otherwise, if there is more liquidity, if there is something that you've added, then the liquidity will be calculated by this and then minted to the message.sender or to the person who has added the liquidity. So this is a check whether you've not added 0 or you've added something. Yeah. So now we have our LP tokens. We can also use them to calculate how much underlying tokens at return when someone wants to withdraw their liquidity in exchange for their LP tokens. And yeah, people have taken this further, like we were talking about eigenlayer. When it gives you the capacity to earn from your staked ETH in other protocols. So sometimes, for example, if you get this LP token and then you stake them somewhere else and you can get, rewards on them, things like that. So we then need to remember how much someone originally deposited, since LP tokens are proportional to amount of ETH deposited. So we can rearrange the above formula to calculate the amount of ETH to return and proportionately calculate the amount of tokens to return. So of course we've talked about one of the mechanisms, the way these liquidity providers are incentivized is fees. So let's look at fees somehow in a more depth manner. Are we still on? Okay, thumbs up are becoming singular. It's a good sign. The heads are tired. Let's finish up with our phase, and yeah, we call it, I think, a session. So now to collect fees on swaps and distribute them among us liquidity providers, we need to think about a couple of things. One of the things is, do we collect the fees in ETH? And then do we pay rewards in ETH or tokens? So do we pay rewards in ETH or the tokens? So one of the big reasons we are really breaking these things down is to enlarge our minds to think about also building things like DEXs, because there's already an underlying business and people need them on L2s, on wherever you're going to, L1s. So you can replicate, take your time and replicate something from Uniswap. We've seen Swap and many DEXs that have, Pancake Swap that are built from Uniswap. So Pancake Swap is for Binance Chain. Yeah, but they bootstrapped from Uniswap and many swaps. So it's a good thing to just know the ins and outs and see if you attempt to build something that is of value. And we collect fees. On each swap. How do we distribute? These fees among these liquidity providers. So all these are questions around fees. These may seem like difficult questions to answer, but we actually have everything we need to answer them. I think from the way we have been arranging our work above. One is that traders are already, sending ETH or tokens to the contract. So instead of asking for an explicit fee, we can just deduct some amount from the ETH or the tokens they are sending. So there's also some other mechanism where you can add more gas fees as someone is sending to the DEX, and you may ask why. So when these people are sending to these liquidity pools, they are going to make money. So having at least a Kickstarter cut off from their liquidity could be one of the things. Or we can just add the fees to the reserve balance. So this means that over time the reserve will grow. We can also collect fees in the currency of the asset being deposited by the trader. So liquidity providers thus get a balanced amount of Ether and token proportional to their share of LP tokens. So Uniswap usually takes 0.03% as a DEX. So on every liquidity that comes in, so Uniswap usually takes 0.03% from each swap. So maybe we can say, as liquidity provider, let's just say for this that we take 1% to keep things maybe moving. Adding fees to the contract is as simple as making a few edits to our price calculation formula. So if we were to add a fees to the smart contract, our formula would become, I think, amount meted. So input reserve plus input amount. And I think so if we are to expand this output amount, we have output amount, input amount, output reserve. Yeah. So if Uniswap is charging 0.003, anyway, for this, let me really stop it here because it will cause more havoc. But yeah, I think on that we can really stop there on the at least introduction to AMMs, what is happening behind the scene. How do we come to have Uniswap as one of the best used dApps on Ethereum? What can we build? Recently, people are looking at Ekubo, and it is a replica of Uniswap, but on Stacknet. There are many things, SushiSwap, an exchange specialized on stable coins. There's another one, an exchange. Specialized on stable coins. And stable coins, yeah. I forget its name. Yeah, it's called Curve Finance. So yes, there is really some good work around it. I would love to hear from you. We have some few minutes. How has been the first month of the cohort? Feel free to share. I think I should stop sharing. Yes, I'd love to hear from us how has been the first month of the cohort. I know the people who are here are really pushing. Yeah, so your feedback is good to see how we can keep moving, how we can make it better. And yes, so anyone please share how have you found the first month? Did people get tired and choose to quit?
No. I think thank you very much for the opportunity to allow us to share our experience. So the first month, it's required a lot of adaptation to the life of an intense learning program. While you're shifting from one thing to learn another, 7 more things come your way, and you have to contain all of them. So I think it's been generally a time of introspection, like to check how fast we can adapt to new things and how fast we learn things. And yeah, personally, I think I've made some progress on increasing the speed at which I learn, and my attention span has increased. So it also has tested my understanding of some of the Web3 concepts that I thought I understood. I realized there's so much I didn't know. Yeah, I think for me that has been a wonderful opportunity, and particularly for this session. I think it's awesome because we've explored a concept that I've always been wondering how things operate behind a DEX. Like I essentially didn't know the difference between a DEX and a centralized exchange, but I think now it's clear.
All right, someone else. Also sharing, like if you get used to really airing out your views, then you become better at it. And one of the issues of builders is they don't know how to air out what they are doing, what they are building. So with these opportunities, I encourage you to, yeah, just share what you've passed through, how your thinking is, whatever, anything it adds value just by sharing. So Podama is in Kamoli, Tracy, Maria. So right, yeah. Before I forget, I think every day maybe we shall be talking about it. So the road show is closed. I think it is this Saturday. So I encourage us to go talk about, yeah, be yourself, what you've learned, share with others, network, um, yeah, opportunities, provide opportunities, and also look for opportunities in any way. So yeah, I hope to see us there. I hope to interact and see how we move forward. Otherwise, if there is nothing more, I would love to say good night.